Will the Niagara region real estate market go down in price, or will it rebound in 2026? I know that there's some people that are out there that want to try to time the market, try to time that bottom, and often people will miss out because of that fear and uncertainty. And I totally understand where you're coming from, and that's why I've created this video, is because I want to provide you with some data to help ease that uncertainty and make you feel more confident without feeling pressured. So we're going to review what the last 10 years of home prices look like in the Niagara region. We'll take a look at St. Catharines, Welland, and Grimsby, and we'll also take a look at the latest sales numbers and how much inventory is on the market, because this is really important. And then we'll see what the experts are saying, the pros, the banks. So we have articles from RBC, TD, and Scotiabank, and they are going to tell us what their predictions are for 2026. And then we'll tie it all together and see what the message is for sellers and for buyers. So let's hop onto my computer. This tool here is called the MLS Home Price Index, and what we'll be using is something called benchmark pricing. And what benchmark pricing is, it's like average home prices, but they clip the highs and the lows to give you a much more accurate representation of the value of the home in a given area. So we'll take a look at St. Catharines. We'll take a look at single family homes, one story. That's pretty much a bungalow there. And we'll do the entire area of St. Catharines. And this is all the data, the home price data going back to January of 2025. So if we take a look at, January of 2005, my brain is not there yet. So in January of 2005, a single family home, a bungalow, was going for $152,900, and today it's sitting at $538,500. And we're going to close in a little bit. We're going to go into the last 10 years. So December of 2015. Actually, no, December of 2016. I'm still in 2025 mode here. And the reason why I want to show you this is you can see that there is a bit of a real estate bubble here. So in this section. So in 2018, December 2018, you can see the benchmark price was $347.4. And then in 2020, we're looking at just a little over 5. And today we're seeing it about 38,000 more in value than it was in December. But for those of you that are looking for the pop, I know that there's YouTubers that are out there that really want to gain attention, and they talk about, real estate is going to crash in Ontario and so on and so forth. This right here should show you that the pop already happened. We had values, increase to the tippity top in February of 2022 at 778.2, and then it dropped within a year. So we have February 2022, and then at the bottom in November of 2022, it hit 573.4. So that is, let me just double check. I'm going to get my calculator here, and we're going to calculate this. So that was 7782, so 778200, and then it bottomed out at 5734, so minus 573400, and then we're going to divide that by 778200, and then we'll multiply it by 100 to get our percentage. So it dropped by a little over 26% in less than a year. That is your bubble popping. If we take a look at the history since 2005, we've never seen that happen before. And the reason why is because we had a once-in-a-century event where, the banks decide to provide really, really low interest rates, and everybody was jumping on the train. So let's go back to our December of 2016. And just to show you guys that this is not something that is only with St. Catharines, but with the Niagara region, let's take a look at Welland. So here we are, same sort of pattern. They peaked at 736.7. Let's take a look at Grimsby. They peaked at just over $1 million. And again, within a year, it lost a considerable amount the bubble popped right over here. I don't see us continuing going down any further. And I also want to point out here, take a look at the timeline throughout the year, the month that we're going through as these things go into their peaks and valleys. So we bottomed out here in October, November, December, January. Now March, April, May in the Niagara region is when activity starts to increase when it comes to buying a home. People want to be able to move into their home when there is warmer weather. So when you buy something, we can close in a couple of months if you want. So in those winter months, you might want to consider, it's up to you, but maybe doing some shopping, taking a look, visiting some places with your realtor or myself. And then that way, when you get into your home at the closing date, you have the advantage of the pricing, and then you also are able to take advantage of the warmer weather, so that way you're not moving in when there's 2 feet of snow. But I just want to show you. So March, April, May, and then it comes back down. We're bottoming up in November and December, and then March, April, May starts to go up again, right? And then November goes back down, January. Now we're in March of 2025. What happened in 2025 around springtime? Well, there was an election, and we also had quite a few people that, were uncertain about the gravity of the, trade war that we have with our good neighbors to the south. And people will put things on pause. They're not sure. They're uncertain. And now people are feeling like, the gravity of all this, yes, it's terrible that the people that are affected by this trade war is suffering, but the gravity and how far spread this is not as bad as we initially feared. Another tool that I'm going to show you is something called Habistat. And this column over here represents all the inventory that's in the Niagara region. So we're talking about condos, townhomes, semi-detached, 2-story, single-story. Everything that is available within the Niagara region is here. And there's 3,082 units that are available for sale. And this column over here is the number of transactions. Out of the 3,082, in November, 332 of them sold. And if we take a look at that calculator again, we take 332 divided by 3,082, that's barely 11% of the homes that are on the market are being sold as of November. Just to contrast that with 2020 and 2021, about 100% of the inventory that was on the market was being sold. If you are looking at buying, that 11% there, you're seeing that you're in the driver's seat. Now let's take a look at what the experts are saying. We have the special housing report. I'm going to link this in the description below, so if you want to take a look, you can click on those links. Easing uncertainty to get recovery back on track. Here they're saying in 2025, we're expecting to see a decline of 3.5%. I should point out that this article was published in August of 2025. So they're letting us know at that moment what the rest of the year is going to look like. And guess what? We saw those price declines, did we not? So that is not due to increased activity. And then they're saying for 2026 that they project a 7.9% rebound in home sales next year. But it's still below the pre-pandemic 5-year average. Not by much, but still below there. And I do want to add here that we are expecting people that have purchased homes in 2021 when things were going crazy, buck wild, to maybe put some of that inventory back on the market because they're facing renewals. So even though that we have an increase in buyer activity, we also have an increase in inventory as well that we anticipate. They also say here that in 2025, we saw the home price average in Canada rise by 0.7%, but then they're expecting it to decline by 0.7% in 2026. So they're saying that home prices will take a bit of a dip. Now, they're also mentioning that Ontario and BC will continue to face challenges as the condo markets in Toronto and Vancouver are likely spilling into other segments. So Ontario and BC, Vancouver, Toronto, they're saying that it's going to be a weaker market, and that's largely driven by the condos. I'm sorry, but Niagara region is not a condo market, right? We have some condos in St. Catharines, in Grimsby, in Niagara Falls, a little bit in Welland, but that's not a core product. A core product for these areas is going to be that single family home, the place that is on a 60 by 120, 140 foot lot. Those are the things that are not being created, right? So we're not going to see large dips in those types of homes that are being offered on the market. All right, here they're talking about pre-pandemic activity, brighter economic prospects to lift confidence. So what are they saying here? They're saying that we expect Canada's economy to gain momentum in the second half of 2025, which it did technically. But keep in mind that the jobs that were created were largely part-time retail jobs. A lot of people feel that this is stuff that was seasonal. So we have to sort of see how things shake out post-Christmas time. We did lose manufacturing jobs, full-time jobs as well, but the net growth in employment did happen in that second half of 2025. Interest rate cuts supporting resale growth. The Bank of Canada rate cuts since June 2024 have yet to fully play out. Last fall's market recovery was interrupted by the trade war, but we expect it will resume as lower borrowing costs trickle through the economy. That said, additional stimulus rate cuts is unlikely. Our forecast anticipates the Bank of Canada will hold its policy rate steady at 2.75 through 2026. Now, is everybody saying the same thing? RBC is saying that the Canadian real estate prices are going to decline by 0.7%. What about TD? They're actually saying that Canada's prices are expected to rise by 5%. But in BC and Ontario, they're saying that it's going to be the weakest housing markets. But they do have a forecast table at the very bottom, and they show here in Ontario for 2026, you can see 2026, that price growth may rise by 3.1%. So on one side, we have RBC that's saying it's going to decline by 0.7%. And on the other side, we're seeing that it may increase by 3.1%. So that to me is just telling me that, there's no clear indicator that, things are going to tank. There's no clear indication that things are going to pop off and explode and run away. It's more of like, hey, we think it's here or we think it's here, and somewhere in the middle, it's probably going to be flat for 2026. What about the interest rates here? This is Scotiabank, and this is published in December, so it's the most recent one out of the three articles. And what they're saying here is that the new year to extend the bank's 2.25% rate pause before migrating towards a 50 basis point tightening. So we're going to see an increase of 50 basis points, which is 2.75%. Well, didn't RBC also say that too? So we have two banks that are signaling that the Bank of Canada will be at 2.75%. This is a quote from the Bank of Canada. If inflation and economic activity evolve broadly in line with the October's projection, Governing Council sees the current policy rate at about the right level to keep inflation close to 2% while helping the economy through its period of structural adjustment. So I don't know about you, but to me, this seems like they have set the dials, and now they're taking a bit of a step back, and they're trying to see what's happening. We're going to wait and see, and then we'll make our adjustments. And they also mention here that Canada's overnight rate of 2.25% is at the lower end of the neutral rate range. Right? The rate range is between 2.25% and 3.25%, and 2.75 is right in the middle, right? Now, this article continues to talk about things that are related to the bond market. The bond market is what affects the fixed rate mortgage, and that's what most people will decide on when they want to finance their home. And recently, we saw an increase in that fixed rate mortgage interest rate. So we see that, and now we're hearing that there's a possibility that the Bank of Canada will increase interest rates, the overnight interest rate, which will affect the variable rate, going from 2.25% to 2.75%, potentially for 2026. So what does this mean if you are selling your home? We're seeing that inventory is at an all-time high. We have over 3,000 units that are available, and only about 11% of them are being sold. We're seeing indicators that are suggesting that the Bank of Canada is not going to continue cutting interest rates, so we're not going to get help from the Bank of Canada to bring more people into the market and buying more inventory. So how do you position yourself to be in that 11% if you have to be? If you have to sell your home, how do you get there? In that first 2-week window, when it first gets into the market, you'll have the most amount of attention there, including organic search and paid search. And if people see that, this has got good value, they're going to want to call their realtor or call in and book an appointment to go see and take a closer look at it. If they feel, because these people have been looking on the market, they're taking their time and they're seeing what is overpriced and what's not. If they feel that it's overpriced, and they can tell, people are smart, they have tools. You will see this too when you're buying your replacement home. And when you see that this price is overpriced, it's going to not gain any attention. People are not going to book to see the home. And then the audience after 2 weeks starts to decline. The organic search starts to decline. Even though you have paid search, the audience will decline over time. And then what happens is you're starting to reduce your price, and you're reducing a price to an audience that is smaller than the initial 2-week window. And what happens is it doesn't get sold because the message goes out to fewer people. And the ones that are paying attention are noticing that, hey, no one's buying this thing, even though that the price has come down. What's wrong with this property? There's a stigma that starts to develop. And we want to try to avoid that if you need to make that move. So my advice is that you want to be able to have someone that can market, promote, advertise the property, but have a property that is priced well, so that way you can increase the chances of success in your sale of your property. What does this mean for buyers? And by the way, I should have mentioned sellers. If you're selling your house and buying a house, if you sold your house for a little bit less, believe me, we'll make up for that on the buying side. Unless you're someone that is in retirement age and you have to cash out and that's it and you're done, the tide lifts all boats is what I'm trying to say. But if you are a buyer, first-time home buyer, by the way, there's no cost to hiring someone like me to help you with the process of buying a home, giving you access to private showings, being able to do the paperwork and so on and so forth, and having access to resources that you could use. There's no cost on the buying side. But buyers, I just showed you, going all the way back to 2005, where the bubble burst. If you're looking at inventory, we have 89% of homes not being sold. You are clearly in the driver's seat. And we're not seeing any sort of indication that rates are going to continue to decline. If you've been paying attention since 2024 and you're seeing, it's going down, I'll just wait for another quarter point. We're now coming down and we are hitting that bottom. And I just showed you that the neutral rate, the Bank of Canada, is now at the lowest end of the neutral rate at 2.25. Some banks say it will stay there. Some banks believe it's going to go up to 2.75. So that is your sign, your signal, your indication that now is the time and you should start getting involved. I'm not saying for you to buy a house tomorrow, but at least contact me. We can start the process, start seeing these places, visiting them, identifying what your needs are, what you like, what you don't like. I'd love to hear your story. What are your goals? Can we achieve them in today's market? I've left my details below. I'll see you next time.